Tesla's second quarter deliveries show that Tesla may have the auto industry baked into a corner and the rest of the auto industry is in trouble. Welcome back, dear friends. This is Armen Haryan from torquenews.com. If you are here for the first time, please subscribe to our channel and ring the notification bell so you may be notified when I upload my next story about this developing subject. This morning, I just reported about an hour ago that Tesla had delivered amazing 90,000+ deliveries in the second quarter, and Loup Venture and the other automotive websites and investor websites are reporting their opinions. There is a very interesting story about Tesla deliveries and what it means, what Tesla deliveries of the second quarter, these better than expected deliveries mean for the automotive industry in general. And there is this report from Loup Ventures, which I'm going to present to you. And also I'm going to read the disclaimer at the end, because Loup Ventures invests in stocks and companies in which they have interest. And therefore they write about topics in which they have interest. So June quarter deliveries are further evidence, says Loup Venture, that Tesla has the auto industry baked into a corner. It's becoming more and more difficult to envision a scenario in which legacy automakers will find a way to meaningfully expand the small share of the electric vehicles that they have today. We expect over the next 2 years, other auto OEMs will struggle to gain measurable ground on Tesla's 80% US electric vehicle share. 10 years from now, once dominant manufacturers will be largely irrelevant in the conversation on the future of the transportation. This is from Loup Venture, and I'm continuing to present their opinions. A supercharged gap between Tesla and the auto industry. Here are some things to consider. For the June quarter, Tesla reported deliveries of 90,700 vehicles, down 5% year over year versus 95,200 in June 2019. Compared to GM, down 34%. Toyota, compared to the June 2019, was down 35%. And the Fiat Chrysler was down 39%. These are hard numbers that we need to pay attention. While an incomplete comparison in March, Tesla's global delivery numbers were up 40% year over year compared to the US auto industry, down 29%. So did you get this? From 2019 June, Tesla is only down 5%. And we know this is all because of the virus as well as regarding the automotive industry. GM was down 34%. Toyota was down 35%. Fiat Chrysler was down 39%. Tesla deliveries in June were up 3% quarter over quarter from 88,400 in March 2020, despite the 33-day Fremont shutdown, headwind in the June quarter compared to 8 days in the March quarter. Tesla produced 82,300 vehicles in June 2020 versus 102,000 in March 2020. A year ago, the company made only 87,000 cars. Tesla is winning because it has a product that is measurably better than both gas and electric competitors. Now let's talk about structurally unprofitable concern likely to fade away. Previously, there were 4 pillars to the cautionary view on Tesla. To date, 2 of those concerns have been meaningfully diminished. The company will run out of cash and Tesla can't manufacture at scale. That was one of the concerns. We believe when the company releases earnings in about a month, the view that Tesla is structurally unprofitable will be meaningfully diminished. Based on the just reported June 2020 quarterly delivery numbers, we expect the company to report better than expected earnings, potentially near a profit despite the shutdown, and favorable details on continued profitability trends driven by the Shanghai factory and Tesla Model Y electric crossover SUV. Now, let's talk about the valuation concern. Valuation concern will remain. Reducing the concern related to profitability leaves valuation as the only remaining pillar to the cautious view on shares of Tesla. If Tesla can continue to capture 70 to 80% share of the US electric vehicle market, we expect, says Loup Venture, we expect shares to remain richly valued and continue higher given the vast market potential over the next 10 to 20 years. Now let's talk about the automotive industry's dilemma. It's becoming more clear that it will be difficult for traditional automakers to catch up to Tesla as demand for Teslas continues to outpace the broader industry. As the company scales to meet demand, Tesla's price performance gap versus other car makers will widen because other car makers are producing electric vehicles subscale, creating a dilemma. Here are some points to consider. If traditional auto releases a car with features and range at parity and sells the car at cost, it will be priced 10 to 25% higher than a comparable Tesla. This will soften demand and lead to further market share loss. Another point, if traditional auto subsidizes vehicles to gain market share, they will lose money with limited margin caution. The more they sell, the more money they lose. Taking it to the logical end, we believe car companies that have been around for 50 plus years will eventually, 10 years from now, be forced to restructure or go out of business. Now let's talk about the move to electric that is just beginning. This year, we believe 3 to 5% of cars sold in the United States will be electric. Tesla CEO Elon Musk has been right on production to date and expects deliveries to grow at 40 to 50% per year over the next decade, which implies ramping annual production from about 500,000 vehicles today to over 15 million vehicles in 2030. Only a few weeks ago, most Wall Street estimates put Tesla deliveries at 60,000 to 70,000 vehicles during the second quarter. It was roughly in the line with the overall automotive industry decline due to the global virus. Here, the Loup Ventures opinion changes ended, and if you remember, Electric reported last week that Tesla could surprise with near record deliveries in the second quarter based on the sources putting North American deliveries significantly higher than most people expected. Following Electric's report, several analysts updated their expectations with the Wall Street consensus setting up at about 80,000 deliveries. Today, Tesla announced that it bet those expectations with just over 90,000 deliveries in second quarter. In the second quarter, we produced over 82,000 vehicles and delivered approximately 90,650 vehicles, said Tesla. The market liked the news, and Tesla's stock jumped more than 9% in pre-market trading this morning, and it's still going up. 90,000 deliveries mean that Tesla is up quarter to quarter from 88,000 deliveries during the last quarter and down only 5%, like I mentioned above, year over year. That's despite having to shut down Fremont factory for the first half of the quarter and having much of its operations affected by restrictions put in place to slow the spread of the virus. For comparison, other automakers, other car makers are reporting much greater drops in deliveries. Audi just reported a more than 30% drop in deliveries in the second quarters. Okay, so here is what Tesla actually said in its release this morning. Quote, "While our main factory in Fremont was shut down for much of the quarter, we have successfully ramped production back to prior levels. Our net income and cash flow results will be announced along with the rest of our financial performance when we announce quarter two earnings. Our delivery count should be viewed as slightly conservative, as we only count a car as delivered if it is transferred to the customer and all paperwork is correct. Final numbers could vary by up to 0.5 or more percent. Tesla vehicle deliveries represent only one measure of the company's financial performance and should not be relied on as an indicator of quarterly financial results. which depends on a variety of factors, including the cost of sales, foreign exchange movements, and mix of directly leased vehicles. I think Tesla employees, friends, should be commended for their work this quarter, because those results are absolutely impressive in the current circumstances. We won't know for sure for a few weeks, but I think it's very likely. Would you think that Tesla will produce report a profit, or at least a break even? Let us know in the comment section below. Now we will have to see if it's enough for a profitable quarter. While these delivery numbers, it actually could work out. With these delivery numbers, it actually could work out, despite the probability for lower income from FCA, as Tesla pulled on several levers. Also, Tesla has sold quite a bit of inventory from quarter one, so most likely quarter two will be a profitable one. Well, friends, let me know what you think about this. And like I said, most of this report was based on the Loup Ventures report, and they have a disclaimer saying we actively write about the themes in which we invest or may invest. So take that with that into consideration, and let me know what you think about Tesla's this morning numbers and the future of Tesla, the future of other car companies, and what other legacy traditional gas car companies should do immediately to restructure and their production toward electric mobility to be relevant in the next 10-15 years. In the meantime, this is Armen Harayan from TorqueNews.com. Please subscribe to our channel. I'm going to bring more of this news to you later today and tomorrow and every day. And I'll see you in our next report. God bless you. Take good care of each other and spend a lot of time with your families. See you soon.